Starting a limited company and wondering what you need to file? Well, listen on and I'll tell you exactly what you need to know. As a business accountant, my team and I spend all day helping business owners save time and tax and of course make sure they're legally compliant and all their accounts are filed with everything they need. So in this video, I'm going to tell you exactly what you need to do and what you need to file. But before we get into it, if you really enjoy this video, make sure to subscribe and click the button below to be notified of more videos just like this one. So, annual accounts, they're the main ones. They're the ones that everybody normally seeks an accountant out for. They know they have to file their accounts. It's just a case of what is it? Well, with limited companies, the main piece you need, and it's the main fee actually when you pay an accountant to do the accounts for your limited company, that's the main thing, the main piece of work you're paying for. And what that is a set of compliant annual accounts, and they can be 10, 15 pages. It just depends on how complex your affairs are. And what they do is they give an account of how the business has got on, and it helps to work out what tax is payable. And we'll talk about tax in a minute. But so these set of accounts, they have to be done to a particular accounting standard, and there's lots and lots of chat and specifics around that, and that's what we've trained for years to be able to do. So that all goes in, and it gets electronically tagged into a piece of software. Now, one of the main reasons you don't see many, or if any, business owners without an accountant is because there's no free software. So with a personal tax return, there's a free HMRC tool, and there's other tools you can use. With a set of limited accounts, not only do you need the knowledge of the accounting standard, you also need this bit of software. So us as a business, we have accountants who are clients. We have chartered accountants who are clients because they don't want to pay for the software license to do it, for example. So it's very normal to find that owners of limited companies have an accountant just for filing, for getting any other tax saving or anything else, just for filing this stuff. Now, your accounts need to be filed 9 months after the company year end. The trick where people get caught out on this is year one. Year one, you get 21 months from the date of incorporation. So if you incorporated on, say, early in the month, you're not going to have the same timescale as you would normally to submit those accounts. So definitely check that out. One of the ways to check is, apart from the company's house, we'll remind you, you will actually, if you go to the public record and type in, so you get a company's house, just Google it, you go into there and you can sit your company name in, it tells you all the key dates. One of those dates will be when it expects for you to file your accounts. Now, the accounts you file with company's house might actually be different to the ones you file with a taxman. So these set of accounts, they get filed with a taxman with a corporation tax return that we'll talk about in a minute. And then you have a decision. You can file those full accounts with the company's house, or you can do a cut down version. They were previously known as abbreviated, but they now tend to be referred to as filleted these days because they changed the accounting standard, blah, 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 blah. It's not very important, but these other set of shortened accounts. The reason you want those shortened accounts is because the full ones show how much money you made, how much money you turned over, and all these other metrics that you might not want to share with the world, whether that's your family or your neighbours or other competitors. You don't want people knowing that detail. So it's very rare do you ever see any file in the small business world these full accounts. So yeah, the cut down version. So generally accountants will prepare 2 different sets. And this is the set that needs to be submitted to company's house in the 9 months or the 21 months from registration. Now, of course, we should mention what happens if you don't file these with company's house. Well, if you don't, you get an instant £100 penalty. Doesn't sound too bad, does it? However, it gets up to £1,500 very, very quickly. And if you do this 2 years in a row, the penalty doubles. And as a side note, you can also end up in court. So we mentioned corporation tax returns. So these are the tax returns where the accounts are taken into account, some other adjustments happen, and then that actually tells the revenue what you owe them in corporation tax. Now that goes, again, electronically tagged to the revenue, and the full set of accounts that the accountant will have prepared go with those as well as one master. Well, oddly, the accounts we mentioned earlier that need to be with company's house have 9 months to be submitted, where the tax return actually has 12, which is a bit odd. And then thrown right in the middle of that is your corporation tax payment still needs to be paid 9 months and a day from the company year end. So what that generally means is accountants will prepare all the accounts in good time, if you've got a good accountant, before that 9 month period. So not only have you got your accounts with company's house, you also know what you need to pay the tax man. And then normally, of course, you're going to file the tax return technically early before the 12 months are up. Bit of a weird one, but that's how it works. Again, with this corporation tax return, there's no free software, as we said, and there are penalties for non-submission. So again, they start at £100 and go upwards. It's the usual type of affair. So make sure that that's filed on time. Now, where people do get caught out on this, we find a lot, is in year one. So if you've got an accountant that's not particularly switched on, or somehow you've managed to do this yourself, be really, really careful with the first year, because quite often Revenue and Customs, when the company's registered, will have a weird idea of what tax returns are needed for that company. And quite often you might see somebody submit a set thinking that's all fine, and there's actually a very small period that needed a tax return, and you end up with a penalty. And again, these things can be appealed in the majority of cases, but it's just something to be wary of. And that's the two main big things out of the way. That's the accounts and the corporation tax return. The other thing you have with Companies House is really it's two returns, but they're sort of built into one application, and that's the confirmation statement and Persons of Significant Control Register, often referred to as PSC. Now, there's a £13 filing fee that you need to do with Companies House, and what this report is it tells the Companies House each year who the shareholders are and who's really in control of this company, and that goes on there. Now, you normally submit that on your anniversary of your company being registered, but what could also happen is if you've submitted it early for some reason is you have a year from that date. So because quite often if you change the shareholding mid-year, it's a bit of an odd one that not a lot gets reported to Companies House in the meantime. Sometimes if you just gave a share to your husband or wife, for example, it might not appear on Companies House at all. And then you might be in a position where you have to try and prove who owns it and there's nothing on the public record. So sometimes people will submit an early one of these reports to sort of prompt the update. Now, in those circumstances, that means now you've only got 12 months from that date to do it. But if you just think once a year is the norm and a £13 filing fee to do it. Now, that is free software to do this, thankfully. You can just log on to Companies House's portal and you can go through there and fill in all the forms and it will let you pay them. And they're not too difficult to do, but you do sometimes have issues where if you have done things with the shareholding where it's going to ask you about rights prescribed in particulars and all this kind of stuff, and there'll be some information to put in there. But generally, if there's been no changes, it's not too difficult a form. If you're interested in what counts as a person of significant control, again, I can do a link in the comments for you so you can see exactly what type of person should be on there. But if you think it's normally somebody, as it sounds, with control, so normally it'd be somebody with more than a 25% shareholding, for example. Now, this one is really, really important. I mean, actually, the accounts have the same problem if you don't file them with Companies House, but I think we see more companies being threatened with this through not filing their confirmation statement, and that's being struck off. Now, the company legally exists all the time. It's on this Companies House register, as it's known, the public record. And what happens is if you don't keep up with your filing obligations, the company can actually be struck off. There's a period where Companies House will write to the directors and say, look, you haven't brought the record up to date with this confirmation statement or this set of accounts. We're going to strike you off unless you do. And then there's a procedure. And eventually they say, okay, we're going to give you notice. We're going to strike you off in 2 months unless you tell us otherwise. And then it's a ticking time bomb for them to contact the Companies House and get the documents in. Otherwise, they will strike it off. The minute it gets struck off, any money that's in that bank account then becomes property of the Crown and disappears. Now, the only way to get that back is to go to court and go through a process to get the company reinstated. I actually did this with a client many years ago, and it is not simple and it can be costly. So it's definitely worth making sure that you're bringing everything you should be, bringing the record up to date, get yourself a good accountant that's on top of this kind of stuff and making sure that that's all in there, because it is a scary moment if you've got, a company you spent years building and then it just gets struck off and ceases to exist all of a sudden because you didn't file a bit of paper. Now, the other one that's quite often talked about is directors may, and they use the word may, need a tax return. Now, for years, HMRC said, if you're a director, you need a tax return. That wasn't actually in line with the law, and as a result, they've changed their mindset on it slightly. But effectively, if you've got tax to pay, because let's say you're an owner director, so you have dividends and things like that, you're going to have tax to pay, you're going to need a personal tax return. So that still doesn't go away. So the company pays its bill using the fact that the company is a completely separate legal entity. To you, it pays its own tax bill, it has its own tax bill, and you as an individual, when you take money from the company, may have your own tax bill. And if you do have anything to pay, then yes, you will need to do a personal tax return. So it's just something worth bearing in mind. Whilst it's not the company's, it still needs doing if you've been issued one. So that's generally all of the things that need filing. And as you can see, some of it you're almost undoubtedly going to need an accountant to help you with. And there's the odd bit in there you might be able to do yourself, but generally people just ask accountants to do it. So if you haven't got one, of course, you can get in contact with us by the details below, and my team would love to help you out. If you found this video of use, please do share it with your networks, and I'll see you on the next one.